Hi students, coming to the FR revision classes. First we are going to discuss conceptual and regulatory framework. So first of all, what is meant by framework? Framework is nothing but it provides the structure and the basic reasons for the preparation and the presentation of the financial statements and what are the reasons for financial reporting is provided by the framework. So generally these framework is of two types. One is conceptual framework and the second one is reporting framework. Conceptual framework and the second one is what? Reporting framework. So here first we discussed what is meant by conceptual framework, then we will discuss the reporting framework. Okay. So first coming to the conceptual framework. So before that, so generally in accounting, there are two approaches out there. One is principles based approach and another one is rules based approach. One is what? Principles based approach and another one is what? Rules based approach. So what is the principles based approach? Generally, so majority of the countries follow the principle based approach. So here we adjust the accounting principles to the company's transactions rather than adjusting the company operations to the accounting rules. So means in case of rules-based approach or rules-based accounting, they frame the set of rules and a set of rules which are required to be followed by the accountant while preparing the financial statement. He has to comply with that rules only. But in case of principle-based approach, they want to standardize the total formats of the financial statement. They wanted to create some guidelines for the preparation of the financial statement. So here the guidelines or accounting principles applied or adjusted to the company transaction. But in case of rule based approach, what happened? Company operations are adjusted in accordance with the accounting rules. In accordance with the accounting rules. So in case of generally the conceptual frameworking follow the principle based and in case of gaps we follow the rules based approach. So nothing but generally rules based approach followed in US and the conceptual framework used in UK and majority of the countries follow the principles based accounting. Principles based accounting. Then what is meant by conceptual framework? What is meant by conceptual frameworking? Conceptual frameworking is nothing but it provides a set of rules and guidelines for recording the financial transactions and reporting the financial activities. Then means how to recognize the transactions and events relating to the entity and how to record those transactions and events and how to present those in the financial statement and how to disclose and how to report them to the users of the financial statements of the entity. So these set of rules and guidelines so relating to the recording of the financial transactions provided by conceptual framework provided by conceptual framework. So conceptual framework is a coherent system of interrelated objectives and fundamental principles, a framework which prescribes the nature, function, and the limits of financial accounting and financial statements. Okay. So first one, so why we have the conceptual framework? Coming to it enables accounting standards and generally accepted accounting practices to be developed in accordance with the agreed principle. So the major objective, what is the main objective of the conceptual framework? The main objective is to total standardize the total accounting policies or accounting principles which are used while preparing the financial statements. So in case of conceptual frameworking, what happened? So he clearly stated, so it provides what guidance relating to the selection of transactions and events, and how they are accounted for, and how they are recognized in the books of accounts, and how they are measured, and how they are presented in the financial statement, and how they are disclosed to the users in the financial statements which are reported to the users of the financial statements of the entity users of the financial statements of the entity. And it avoids the firefighting. So sometimes there may be a inconsistency in between accounting standard and the legislation. So in that case, which we have to follow, whether accounting standard prevail the legislation or legislation will prevail the accounting standard. So we have to follow the which policy. So whereby accounting standards are developed in a peaceful way in response to specific problems and abuses. So firefighting can lead to inconsistency in between different accounting standards and between accounting standards and legislation. So for avoiding these inconsistencies, we need what conceptual framework. And so next one, the lack of conceptual framework may mean that certain critical issues are not addressed. So here, critical issues are nothing but, for example, coming to the financial statements, what are the elements of the financial statements? Assets, liability, expense, income, equity, cash flows, etc. So these are all what elements of the financial statements. So if these conceptual framework is not provided, then we don't know even the definition of these basic terminologies relating to the elements of the financial statement. Next, as the transaction become more complex and businesses become more sophisticated, it helps preparers and auditor for financial statement deal with the transactions which are not subjected of an accounting standard. So, and accounting standards based on principles are thought to be harder to curriculum it and thought to be harder for implement. So, conceptual frameworks strengthen the credibility of the financial reporting and accounting profession, and it makes more easier of the financial statement. It makes more confidence on the financial information provided in that statement by providing that type of guidelines which are used in preparation of the financial statement. Okay, then coming to the rules based approaches. So till now we discussed what conceptual frameworking, which was framed based on the principles based in accounting. But coming to the rules based accounting, we call it as what cookbook approach. Cookbook approach. So cookbook approach, in that case, what happened? First, they frame the rules. According to the rules, they frame the rules, and the rules may vary from the company to company. So based on that rules, so they prepare the financial statement. So in that case, so the main feature of the financial statement is not possible. The best example is comparability. Comparability. And coming to the next one, what are the purposes? What is the main purpose of the conceptual reporting framework? So the main purpose is nothing but so to assist IASB. IASB stands for what? International Accounting Standard Board, to develop IFRS that are based on consistent concept. So it provides conceptual reporting framework or conceptual framework. It provides what? It provides assistance to the IASP while developing the IFRS, and it assists preparers to develop consistent accounting policy where no standard applies to particular transactions or event, or when the standard allows a choice of accounting policy, and it assists all parties to understand and interpret the standard. So these are the three basic objectives. Why the concept? What is the main purpose of the conceptual framework? So first of all, it assists the IASB while preparing the IFRS standards, and it assists the preparers to develop consistent accounting policy where there is no separate standard is available for particular transaction or event, or it may help in revising that standard also. It may help in revising that standard, and it assists all parties to understand and interpret the standard. So these are the main purposes. Of the conceptual framework. And so first of all, this new conceptual framework for the financial reporting consists of some elements. So one is for objective. Of general purpose financial reporting, and the second one is what? Qualitative characteristics of the financial information, and the third one is what? Financial statements and reporting entity. Financial statements and reporting entity. And the fourth one is what are the elements of the financial statements, and recognition and derecognition of the transactions and events, and measurement and presentation and disclosure, and the last one is concepts of capital maintenance. Concepts of capital maintenance. These what we are going to discuss in case of conceptual reporting. So this conceptual frameworking contains these topics. So first one, objective of the general purpose financial reporting, and qualitative characteristics and financial statements and reporting entity, elements of financial statement, recognition and derecognition of the transactions and events, measurement, presentation and disclosure, and concepts of what? Capital and capital maintenance. This is what we are going to discuss. Okay. And first of all, previously, before IFRS, we have what? IAS. So which was established by IASC, International Accounting Standard Council, and later it renamed as IASB, International Accounting Standard Board. And so that IAS are renamed and revised as what? IFRS. And what are the, how many standards are there? What are the components? We will discuss in reporting framework. Next, then coming to the first one, what is the objective of the financial general purpose financial reporting? So the main objective is to provide the financial information about the reporting entity, so which is useful to the users of the financial statement. So what is meant by users? Users are nothing but those persons who involves in day-to-day business operations of the entity, and those that information which is useful to the users means it may change the decision of the users of the financial statement. That type of information required to be provided to the users. Required to be provided to the user. There are a number of users are there surrounding the environment, like owners and investors and customers, suppliers, government, public. So these are all covered under users. They need the different information. So single information is not required for each and every person. They need what different information. So that's why we have to provide what useful information to the users. Useful information to the users. And when we say that information is useful, when it has that qualitative characteristics, if the information satisfies these characteristics, then we say that information is a useful information. The first one is what? Fundamental qualitative characteristic. There are two fundamental qualitative characteristics are there. One is relevance and another one is faithful representation. Relevance and another one is what? Faithful representation. Here, what is meant by, sorry, what is meant by relevance? So relevance is nothing but if the information is relevant, if it has an ability to influence the economic decision of the users, to influence, if it has an ability to influence the economic decision of the users of the entity, that information is said to be relevant and which is provided in time to influence those decisions. So for example, last year inventory around 10 lakh dollar is there. So coming to the inventory, so in the year 2000 X1 10 lakh dollar is there. In the year 2000 X2 2 lakh dollar is there. So what is the change in the inventory? Unless otherwise stated, majority of the persons feels like so that sales happened during the year. But for example, that reduction in the value of inventory is because of fire accident occurred in the store. So due to that 8 lakh worth of the inventory was damaged. So this is most relevant information to the users of the financial statement because based on that, the party may take a decision whether he may continue with the business or not. That type of information is said to be what relevant. So information is relevant when it is a predictive and or confirmative value, confirmatory value. So when it is predictive and confirmatory. And the second one is faithful representation. So if the information is to represent faithfully the transactions and other event, that is to represent, they must be accounted for and presented in accordance with the substance and economic reality and not merely their legal form. So means if the financial transactions represents a faithful representation, means while recording the transaction, we consider reality of the transaction rather than the legality of the transaction rather than the legality of the transaction. Simple way we call it as substance over the form. Substance over the form. Has to followed while in case of faithful representation. For example, coming to the hire purchase transaction, so generally at the time of entering into the contract, seller transfer only possession of the goods to the buyer, and the buyer so pay the amount on installment basis. On or after making the last installment only, seller will transfer the title to the buyer. So, but even it means the title is not lies with the buyer. Title always lies with the seller till the last installment paid. Even though ownership is not there with the buyer, even though owner has a right to recognize that item as an asset in his books of account as he utilized that asset in for the business purpose. So here reality of the transaction or incurrence of the transaction has more priority than the legal formality that indicate what? So substance over the form. So to be perfectly faithful representation, financial information would possess three characteristics. So when we say the faithful representation, we have to satisfy three characteristics. The first one is what? Completeness. And another one is what? Neutrality. And another one is what? Free from error. Free from error. If these three characteristics are satisfied, then we say that information is faithfully represented. We say that information is faithfully represented. Okay. So this is about what? Relevance. What are the qualities of relevant? So two, it must be predictive and confirmatory. And coming to the and one more thing is here. So where the choices has to be made between mutual exclusive options. So the option selected should be one that results in maximum relevant information. In other words, the one that would be most used in taking the economic decision. We have to select that one only. We have to select that one. Then coming to the second characteristic, nothing but faithful representation. So in case of faithful representation, to consider three characteristics has to be followed by that information. One is completeness, neutrality, and free from error. Free from error. So these three has to be followed. And then next one is enhancing qualitative characteristics. Enhancing qualitative characteristics. So there are four enhancing qualitative characteristics are there. The first one is comparability, and second one is verifiability, and third one is timeliness, and the fourth one is understandability. So comparability here in the sense we compare the financial statements of an entity from one period to another period or from one entity to another entity. So one period to another period, one entity to another entity. So for this to be the case, there must be a consistency and disclosure. While comparing the financial statements, we have to verify whether accounting policies are consistently followed or not while preparing the financial statements of the entity. And second one is verifiability. So verification can be a direct or indirect. So direct verification means verifying an amount or other representation through the direct observation. Nothing but like, for example, physical counting of the cash. You go to the cashier and took the physical cash and verify how much amount is available and confirm with the financial statement. That physical verification is nothing but what? Direct verification. And there is an indirect verification is there. There is an indirect verification is there. So that is nothing but, for example, coming to the next one. So we calculate present value of an asset. How to calculate the present value of an asset? By discounting the future value to the present value. And here we confirming the value of an asset by using some formulas. So those are said to be what? Indirect verification. So here we doesn't have any physical counting, we doesn't have any direct verification. So just we believe the information provided by third party or using some formulas, etc. That is covered under what? Indirect verification. Next, indirect verification. So that is verifiability. Next, coming to the timeliness. So timeless means having the information available to the decision maker in time to be capable of influencing the decision. For example, if the information is not available in time, then there is no use to that party. There is no use to that party. Then coming to the next one, understandability. Understandability depends upon the way in which information is presented, the way in which information is presented and the capabilities of the users. So generally that information, the requirement of the information changes from one person to another person. So one party requires some type of information, another party may not require that information. We have to present the financial information in such a way which is useful and understandable to the each and every user of the financial statement. Every user of the financial statement. So this is about the objectives. And then, so that is the second one. Next, coming to the third one, elements of the financial statement. So before that, so what is meant by financial statement? Generally, financial statement consists of five items. One is statement of financial position, nothing but a balance sheet, and a statement of profit and loss and other comprehensive income, and statement of changes in equity, and cash flow statement is there, and the last one is what, notes on accounts. Notes on accounts. So the next one is nothing but what are the financial statements and reporting entity. Here we use the word reporting entity. Reporting entity is nothing but the entity that required or chosen to prepare the financial statement. The entity for which we require to prepare the financial statement, that entity is said to be our reporting entity. So there are five types of financial statement, five components of financial statements are there. So the list is provided here. Then coming to the next one, what are the elements of the financial statement? So here elements of the financial statements are nothing but there are six elements are there. One is assets, another one is liability, another one is equity, income, expenses. Majorly these five elements are there, and the another one is cash flows are also covered. Cash flows. And then just coming to the definitions. So asset is nothing but what? It is an economic resource controlled by an entity which provides some economic benefits to the entity in future is said to be a what asset. Generally, that asset is classified into the two types: current asset and non-current asset. Current assets means those assets which provide economic benefits to the entity within one accounting period, said to be a current assets. Otherwise, those are said to be a non-current asset. Then coming to the second one, liability. It is the present obligation of an entity which create some economic outflow, which creates some outflow of economic resources to the entity in future. And it is also created based on what past event. And these are also classified into the two types, current liability and non-current liability. And which are liable to pay within one accounting year are called as current liability, otherwise said to be a non-current liability. Next, so equity. Equity is nothing but what? The residual figure of assets and liabilities. The difference is between assets and liabilities said to be about equity. Then coming to the income and expenses. Generally, here income and expenses are provided or defined. So based on financial position approach. Financial position approach. So generally, income is nothing but what? The total amount received during the period. Here we define it as what? Increase in asset or decrease in liability. So increase in asset or decrease in liability, which results in what? Increase in equity. So so income includes what? Increase in asset or decrease in liability, which results in increase in equity, is called as what? Income. Expenses are nothing but decrease in income or increase in liability, which leads to decrease in equity, said to be what? Expense. So this type of definition is provided by financial position approach. Generally, what is meant by an expense? Expense is nothing but the total amount spent by the party while receiving the goods or at the time of receiving the services. Said to be about expense. But here we define in terms of assets and liability and equity. That's why we call this approach as financial position approach. These are all the types and the general definitions relating to the asset and the liability. And the next one is what? Recognition of the element. Okay, so recognition of the element. So what is meant by recognition and derecognition of transaction? Recognition is nothing but creating an item on the face of the financial statement, either in P&L statement or balance sheet. So recognition is nothing but it is the process of capturing the inclusions or additions in the balance sheet are profit and loss statement. Profit and loss statement. So when we create an item on the face of the financial statement, only when it meet the recognition criteria, only when it meet the definition criteria of that item, then we recognize that item on the face of the balance sheet or P&L. On the face of the balance sheet or P&L. So that is nothing but, for example, coming to the balance sheet equation. So first equity plus liability plus income is equal to what? Assets plus expenses. So this is what is meant by an accounting equation. What is meant by an accounting equation? So here, how to recognize these all things on the face of the financial statement? That is nothing. How to recognize the expense? Then how to recognize the income? How to recognize the income? When it meet the definition criteria of the income, recognition criteria of the income, like what? So income is nothing but what? Increase in asset or a decrease in liability, which leads to increase in capital, is said to be a what? Income. If any item which meet the definition criteria of that income, we recognize it as an income. So when we say that information meet the definition criteria, when it is useful to the financial statement. How can we say that information is useful when it satisfies the 2 points, two characteristics are qualitative characteristics, that is nothing but relevant and faithful representation. So in case of faithful representation, three characteristics are there: completeness, neutrality, and free from error. So these are all interrelated to one and another. Okay. So recognition stands for what? Creating an item on the face of the financial statement. When we created, so only when it made the recognition criteria. So for meeting the recognition criteria, that information is said to be useful information. When we say that information is useful, when it satisfies the two characteristics, that is nothing but what? Relevant and faithful representation. Faithful representation. Okay. Next. So next, coming to the another item, derecognition. So coming to the derecognition is nothing but adding the item to the balance sheet or profit and loss statement. Derecognition means removal of that item from the balance sheet or profit and loss statement is said to be about derecognition. So derecognition is the removal of some or all of an asset or liability from the statement. When we derecognize, first of all, when it meet the definition criteria, if it does not satisfy the definition criteria at any point of time in the future, then in that year just we remove the respected item from the financial statement. The process is said to be about derecognition. Generally, derecognition create what? It creates some. It loses the control over the asset, or it has no present obligation for liability. Okay. So this is about what? Derecognition. So derecognition achieved by derecognized any transferred or expired or consumed component and recognizing a gain or loss on the above, recognizing any retained component. Best example is sale of so plant and machinery. In that case, we can recognize what? Either profit or loss. So this is about what? Conceptual frameworking. Conceptual frameworking. Next. So conceptual framework and measurement. So generally, first we identify the transactions and event. Then the next question is how to record. For recording that, we need to measure the transaction. So for measurement purpose, generally there are two values, two approaches are there. One is historical cost, and another one is what? So present values, nothing but what current values, current value. So here in case of current values, we may have realizable value, current cost or replacement cost, and another one is value in use. Value in use. Then, so here there are four valuation rules are there: historical cost, current cost, fair value, and value in use. Nothing but present value. So what is meant by historical cost, sir? Historical cost is nothing but so the amount already spent relating to the asset, at what price you purchase that asset. That price is said to be what historical cost. For example, we purchased the plant and machinery for 10 lakh dollar on 1/1/2000 expense. This 10 lakh dollar is said to be about historical cost. Then on 31st December 2000 X1, so means we use that asset for 1 year. Then what is the historical cost here? Cost less depreciation till this date. Cost less depreciation till this date. That is said to be about historical cost. In the first year, we consider cost of the asset or amount spent is said to be historical cost. But in the subsequent period, we have to consider what cost less depreciation as a historical cost. Then what are the alternatives available? Alternative valuations are available. Alternative valuations are nothing but, for example, if the company wants to purchase the asset at a present in the market. For example, I purchased the plant and machinery 5 years back and for 1 lakh. So then we provide the depreciation for these 5 years. Then what is the book value of the asset? Around 40,000 is there. For example, 1 lakh to 40,000. 40,000 is there. So then if I want to purchase the same machine at a present, how much amount I require to pay in the market? That is said to be about current cost. Or we say it is what replacement cost. And another one is if you want to sell the product in the market, then how much amount you can realize. This is called as what? Realizable value. Realizable. And in some cases, we may call it as what? NRV. NRV stands for what? Fair value minus cost to sale. Fair value minus cost to sale. Then the next one is, so this is the present value or value in use. So that is nothing but what is the present value? So summation of present value of discounted cash flows in future. So means after 1 year, 10,000 is there. After 2 years, 20,000. After 3 years, 30,000. After 4 years, 40,000. These are the benefits we are going to receive from the asset. From the asset means these are all what future values. We are going to uh, we are going to earn. We are going to earn by using the asset. How much amount? 10, 20, 30, 40 at the end of first, second, third, and fourth years, respectively. Then for bringing that future value to the present value, we apply what? Discounted values. Then that formula used. In that case, whatever the amount you arrived is said to be what? Value in use or present value. Value in use or present value. Clear? Then coming to the historical cost. Here, in the case of historical cost accounting, what happened? Here we record only transactions already incurred. Transactions already incurred. So means if any transaction which involves the payment of money, that monetary transactions are only considered. If any non-monetary transactions involved, then those are not considered in case of historical cost accounting. Just ignore the non-monetary transaction. It just ignore the non-monetary transaction. Okay. Then, so income for each period is normally taken into account only when the revenue is realized. So, but coming to the expenses, we recorded based on what? Accrual basis. And profit is calculated by using the matching the income against the cost of item consumed in generating the revenue for the pay. Simply said, cost less means income minus expenses. Hmm. So, what are the advantages? Easy to understand, it's straightforward to produce, and historical cost accounts are most objective and free from biasness. So, these are all what advantages and disadvantages. Coming to disadvantages, carrying amount of non-current asset is often substantially below the current one. Generally, in case of financial statement, while preparing the while verifying the non-current asset, that non-current asset is always recorded at what price, either at cost in the first year or in subsequent period. We have to show at what cost less depreciation, nothing but what book value. But when we compare that amount with the current value in the market, it may be less than that one. Okay. Then second one is inventory in statement of financial position reflects the prices at the date of purchase or manufacture rather than those current at the year end. And statement of profit or loss expenses do not reflect the current value of assets consumed. So profit in real terms are exact. Just we consider the current value. We does not consider the current value of that asset. Current value of the asset. So whatever the profit show, which are prepared by using the historical cost method, are not real. If the profits are distributed in full, the level of operation would have to be curtailed. Okay. No account is a take of the effect of increasing prices on monetary items, and the overstatement of the profits and understatement of the profit prevent a meaningful calculation of the return on capital employed. So these are all drawbacks relating to the historical cost accounting. So here, just see this example. Say a company has a machine which it purchased 4 years ago for 1 lakh and accumulated depreciation on the machine till the date 40. So means here historical cost is equal to 1 lakh minus 40, that is nothing but what, 60,000. Next, the machine could be sold to another manufacturer for 50, but there would be a dismantling cost 5,000. So 50,000 minus 5,000 equal to 45,000 is said to be NRV. And to replace this machine with the new version would cost 1,10,000. And if you want to purchase that asset at present, how much amount required to pay? So that is related, that information is relating to what? Present value, or sorry, replacement cost. So what is the actual, if you want to purchase, how much amount required to pay? 1,10,000 required to pay. Then how many years already completed here? So 4 years, I think, 4 years. So we need to provide the depreciation for how many years? 4 years. The total life is 4 plus, so sorry, for 4 years, how much amount provided? 40. Means the life of the asset is around 10 years. So here we need to provide what? 44,000 is the depreciation. 1,10,000 by 10 into 4, 44. Then the remaining amount is how much? So 66,000. So this is said to be 66,000. This is said to be our replacement cost. And another one is economic value. Economic value stands for, economic value is nothing but what? Fair value. Present value. So present value, how to calculate? So here he clearly stated the cash flows from the existing machine or established 25,000 for the next 2 years. Okay. So 25,000 for the next 2 years. So 1, 2. So 25,000 and 25,000, and followed by 20 for the remaining 4 years, means 3 to, so 3, 4, 5, 6. So 3 to 6 years, how much amount? So 20,000. Then what is the present value factor for year one? Means 0.9091, and for second year 0.826, So from the third year onwards, we are going to receive 20,000. So we apply annuity factor. So into 2.619, 2.619. Then if you calculate it and total it, then whatever the amount you get is said to be about present value, and we say it as what economic value. We say it as what economic value. Okay.